All right, big shout out to Diego and Fauci here, pointing out HXRO, Bitness, etc. Now that I've got the flash loan, coding up a flash loan course out the way, what I want to do is actually now focus on catching up with you guys on these comments here. So HXRO, Diego, you said please check if you can do this analysis on HXRO. You were referring to the PancakeSwap predictions here. They have a similar system, but odds are more tight between 1.7 and 2.3. Okay, where you can still get a tiny edge. For example, we can predict with ML maybe a 52 to 55% hit rate, etc. So it's a very good point, very good question in my opinion. Remember, I'm not qualified. Trading is not my full-time business. Developing is. So just make sure that you take this with a pinch of salt. And if you don't agree with anything, critique it in the comments. And that goes for everyone watching this. So please do criticize or point out if you think something's incorrect. But I do want to give you my opinion on this because I thought it was a really good question. And actually what I'm going to do here in this video is compare HXRO to PancakeSwap Predictions to Bitness. And then I'm going to talk about how to arbitrage. Or how I would look to arbitrage this, because HXRO has this TIX options and WIX options, and that opens a whole nother door here, which I absolutely want to talk about in this video, because I think if you're anything like me and you love this stuff, you're going to really enjoy that. So first of all, let's go over here. Let's go to the 5-minute bars. Now, big assumption. Let's assume we can't predict direction of the market. Very few people can. Maybe in crowds they can, but we're going to talk about that more in a moment in line with a comment that was posted on the recent video. But let's assume you can't for now, right? So that's under that assumption. Really what I need is at minimum a 3% edge, so like a 2.03 payout or something like that to make this worth my while. If you find something like 2.3, like you had seen in your comment, absolutely, I would take that trade all day, every day. All day, every day. But here's the problem. The problem is the execution. I haven't spent much time looking for the actual program behind this, how to interact with the blockchain and actually read this like I did with PancakeSwap. With PancakeSwap, I got like 3,000 rows of historical data from the blockchain and analyzed that in the last video. And that was the video I posted, I think it was yesterday. For this one, I haven't done that yet. But what I would say is it's really not clear here, right? It doesn't show you for what's up and coming, and maybe I'm not clicking in the right place or whatever, but like what is the weighting between bulls and bears? And will it settle at the last second where it shows at the last second? Because PancakeSwap Predictions doesn't do that, and that's why I said this is just pure gambling. Don't do it. I spent £100, which is $120, $140 or whatever, worth of test money, real money, on PancakeSwap Predictions to test it out. And I'd proven there was no statistical arbitrage, unless maybe you sat in like a mempool or whatever, different topic for a different video. But I'd shown there's no edge there. And so, here I'd say you need to know that you can execute that. So number one, first question is, can you read that? So can you see the 2.3% payout or the 2.15? Again, 2.15, I would take that trade all day, every day. All day, every day. Can I see that? And can I get in? And is it certain that if I see that price at the time I place the trade, right down near the end of the time limit, that I will get that payout? Because if it is, I would take that trade all day, every day. The other question is, will it work with the law of large numbers? And so, in other words, does this happen frequently? Does that sort of payout ratio happen all the time? Because remember, if you have no edge in predicting direction, you've got a 50-50 chance. And so you need the law of large numbers, right? You need 1,000 trades to play out for you to be making money consistently over time, because you're going to have cycles of downsides. You could have 12 losing trades in a row, which just eats away your capital, right? So, and you can also have 12 winning trades in a row, which really exponentially grows your capital, followed by, whatever. It doesn't have to be 12, it could be anything. So you can have losing streaks and winning streaks. So you need the law of large numbers to play out. Does it happen often enough? And I haven't spent any time looking at that. Potentially I'll do that for another video like I did with the PancakeSwap one. And I forget whether this is trading through Solana. I think this might be through Solana, but I do know that HXRO, there's an ERC20 token for HXRO. If you guys have looked at that, definitely have a look. So HXRO, it does TIX options and WIX options. I want to talk about option arbitrage. I'm going to get into that in a moment, talking about these. But let's jump over here to, PancakeSwap predictions market. So this here is a very good interface. It's laid out very well, but as I summarized in the video I posted yesterday, this is complete gambling because you really don't know what payout you're going to end up with. And if you don't know that, it's pure gambling. If I knew I was going to, for example, here end up with a payout of 2.11, I would have, again, taken that trade all day, every day. Here, 2.27 all day, every day. Here, 4.57. Even though I would have lost that one, I would have taken it all day, every day. 2.17, sorry to say it again, all day, every day. But you can't, because the problem is that payout drastically changes in a calculation that's done once the timer on this stops, right? And I don't know if there's people sitting watching the mempool and if there's any manipulation going on or some, let's call it privileged trading for people that are running these mempools and whatever, which, by the way, anyone can do. So I'm not saying it's illegal and it shouldn't be done. I'm just saying I don't know if any of that's happening. Let's assume it's not, because one of the wizards actually posted a comment on the video, really intelligent comment, I thought, saying, well, Sean, actually, maybe the market en masse can predict the future of this price, which I thought was really interesting, because what I'd done in the last video is there's 3,000 rows of data, right? So let's actually put in here, let's go to Crypto Wizards here. I'm just going to go to my channel and go to videos. And I think he commented here on this video. The reason why. Let's see. So here, I don't know what you're implying here. So this was Traffic Adventures, Germany. I don't know what you're implying here, but would you have actually calculated, what you have actually calculated is the combined wisdom of Pancake players are about 57% accurate in predicting the next 5-minute sign of returns. Really intelligent answer, and actually goes into this in more detail, to which I actually responded as well to that over here. And again, there was a response of that. So yes, the payouts do have some predictive value. So there's some really good conversation, and actually I need to reply to you on this. There's some really good explanation here, or understanding or thoughts around, can you predict this? Because what we had done here in this video is we had actually gone and pulled 3,000, this video here, 3,000 rows of data, and said that, if the liquidity is weighted towards the bulls or the bears, 57% of the time, they're actually right. Meaning, and that's over, again, it's over the law of large numbers, a large enough sample of transactions. And that's consistent because I ran it recently again as well for something. So it's actually consistently doing that from what I can see. You can test it yourself. What that means is that maybe the market, if there is no manipulation, if there's no manipulation going on, what that means is that the market can predict in the next 5 minutes what could happen. And, theoretically, what that means is you can use PancakeSwap predictions, not to trade it, but to use it as a leading indicator for trading the price direction of BNB USD, and you have a 57%, you have a 7% edge. Amazing. Like amazing. If that is the case, this is amazing, right? So that's one way to look at that. Let's move over to Bitness here. So Bitness, I'm not going to put down any of these platforms, right? I don't want to talk negatively about any of these platforms because I applaud any platform bringing out tools for traders and vehicles for traders, because this is what we want, right? I love this stuff. I love it. I'm so happy that these vehicles exist. The reason why I'm not keen on Bitness, and I will talk in a moment about the things I am keen on, by the way, but the reason I'm not keen on Bitness is, again, fees. For every $1 I'm risking, what payout am I getting back? If it's not near $1 at least, or $1.20, $1.30, I don't want to take the trade, right? Bitness here claims it's got the lowest fees, etc., etc. You can look at their website. I'm not sure that's the case. I'm just not sure that's the case. And the reason I'm not sure as well is not only did I look at the fee structure, But I also looked at the fact that, they have an affiliate program. 50% payouts for all the people you get to sign up, and when they trade, you get half of the fees. This is a money printer, but not for you. I think it's a money printer for Bitness. I could be wrong, Bitness. Apologize. You feel free to argue with me in the comments here. But I'm just calling what I'm seeing here based on the fee structures, etc. And I'm not saying that's wrong, but it's not for me, right? If I wanted to trade and make good money month in and month out with my trading strategy, I would not choose to trade here. I just wouldn't do that. Now, that said, maybe I've grossly misunderstood something about this platform and the fee structure, in which case, please do correct me here in this video, because we need to make sure that traders who are watching this and reading the comments are getting the truth. That's what's ultimately important. So that would be my view, comparing these here. Now let's talk about arbitrage, because here I've got Deribit. I could have Quedex up here as well, but I've actually just got an options train in front of me, and this is for a contract on the 24th of June. So if I go over here to HXRO, you'll see we have these TIX options. And with these TIX options, what they mean is you can choose an expiration. So here I'm going to choose 24th of June. And I'm going to, place a bet here, let's say whether Bitcoin closes above the price of 36,000. Right now it's at 35,875. And so the payout is actually 1.903 if it ends above that price, which is really interesting. Because here, if I hover over that, it actually tells me the percentage probability that that will happen. Now, another a piece of terminology for this market probability is what you call probability in the money. And I'm pretty sure it's the same thing as what HXRO trade are showing here. Probability in the money. So if you don't know what probability in the money is, watch this video. Probability of in the money versus probability of touch. This is by Option Alpha. I actually watched it again. I've watched it so many times. I watched it again recently. This is such a good video. It's probably like my favorite video on options trading in general, because it's just, you need to understand this stuff, right? If you're going to be trading anything actually. People who don't even trade options, who are trading direction based, I think should understand the market mechanics, and options are a good way to do that. But look at this, right? So it's showing me this payout. Where's the arbitrage? Well, let's look at another platform, right? Let's look at Deribit. And right now the price is at 35,882, 36,000. I can buy a call option, and it's going to cost me in dollars $2,967. So where's the arbitrage? Well, what I've done here is I just went back to the Excel model that I created for the very first video ever done on this channel. And it's so cool to have an excuse to go back and resurrect it. And I've actually downloaded it. So let me go and open it here and enable macros. Now I'm going to do all of this manually typing in Excel because I'm on a Mac, and the macro that I built to make this easier doesn't work on a Mac, which I've found out, which is really annoying. But anyway, I'm going to zoom into this. So where's the arbitrage? Well, let's have a look here. First of all, at our playbook, because what this shows you is it shows you the payout, right? So as the price of something goes up, how much profit will I make? If the price of something goes down, how much loss will I make? So let's assume here that when I built this, the price of Bitcoin was $7,000. Can you believe it? So here we are, 36,000 is the actual coin price is 35. I think it was 35. Let's actually just go and grab it from Deribit. 35,830. Okay, so 35,830. Right, that's the price right now. 35,830. And actually, I'm just going to copy that and paste it there as well, across, because I'm going to use three trades. I'm actually going to combine three trades here to see what my profit and loss would look like, hypothetically. What's the implied volatility right now? Well, it's around 57 or 58%. So let's just put this at, I'm just going to call it 58%, 58%. And I'm going to do that down here as well. All right, great. And the strike price is 36,000. So the strike price is the same here. So this is not really an introduction video to options. I don't want to make this video too long, but just go with it here for a second, because I think this is going to be really cool for anyone who doesn't know what put call parity is and how you can arbitrage this stuff. So here we are, 36,000. Risk-free rate, I'm actually going to put it 1% because right now the risk-free rate is bloody low, so we might as well put that really low. And this is going to be a call option. Let's assume I've got a call option here that I'm trading. Now, what's the expiration date? 24th of June, 2022. So I'm going to put that in, 24th of June, 2022. And let's just copy that over here. Oh, whoops, historical volatility. Sorry, that's supposed to be 58%. I'm just going to put in there. Risk-free rate, I wanted to put that as 1%. Now look at the price here of my call option, right? This is the Black-Scholes options pricing model. $2,976. Probably in the time it took me to do that, the price here has moved. But here you can see $2,945 or $2,999, depending on whether you're on the bid or the ask. So same price, okay? Broadly speaking, we've matched the price of Deribit here. This is what it would cost me to buy a call option. And if I just zoom out here on my chart and I put this equal to the expiration date minus 1 second, this is what my payout would look like at expiration, right? So this is the formula for anyone looking to replicate this that I'm doing here. Now, what that means is a call option means that I make money if the price goes up, and I lose the cost of my call option if the price goes down, but my loss is fixed. So I have unlimited upside and fixed potential downside. That's just a straightforward, typical call option. Now, what is interesting about this is, do you remember when I was just buying coins? So if I change that rather than it being a call option just to buying the actual coin, you can see make money, things go up, lose money, things go down. That's just trading, right? You buy something, makes money going up, loses money going down. With the call option, I have this scenario over here. Now, let's actually just go back here and zoom in to our chart. So I'm going to zoom into this point here where it crosses the 0 line. So 35,830, which is the current price. That is the mark of where I make and lose money. If I buy at that price, $1 over that, I make $1. $1 under that, I lose $1, right? All right, bear that in mind. Now let's put that back to buying a call option. And let's do something else here. Let's go and sell a put option. What does that look like? So if I go and sell a put option, I have what looks to be pretty much exactly the same as if I was buying or, just buying the coin. It makes money when it goes up. It loses money when it goes down. Interesting. Okay. Well, that would make sense. But now let's go into a different scenario. And by the way, you'll notice the put option is more expensive, right? It's 3,000 because already, number one, it's more expensive because we're already in the money on the put option. Or it would be more expensive. So we're not buying this at 3,000. We're selling a contract where we take 3,000. Let me just remind folk, just as a refresher, with put options, if I'm buying a put option, so if I buy a put option, I make money when things go down. If I sell a put option, I get a fixed income. But if the price starts going down past this point, I just continually lose money. Right? So that's selling a put option. But if I do that against buying a call option, I end up with this. So this is what this payout does. It combines your strategies. That's what I'm doing here. Right? I'm combining my strategy. Now, what is interesting about this? Well, let's go here. So look at these implied volatilities, right? And implied volatility is really derived by the price that the market's willing to pay for that option. And you'll notice these implied volatilities here are swinging massively, right? They're all over the place. You could just trade this implied volatility. It's easier to trade volatility than direction, in my opinion. This would have implied volatility in it. Look at these payouts. You can't see it because it doesn't have an options chain, right? But it's got this here as well. It's got that look. Now, how do I know this is close to Deribit? Well, the reason I know is because look here, it's saying that the market probability of being in the money is 52.5%. And if I go over to my option chain here and I look at this 36,000 level, it's 53% give or take probability in the money. Now, this is the delta I'm looking at, which is a proxy for probability in the money. If you're wondering what that is, just watch this video here. It was very helpful for me years ago. Very helpful. But this means that there's a chance of it being roughly 53% there in the money. And this is clearly priced it as such over here. Now, I don't understand how these prices are put together. Where's the liquidity coming from? How much depth is there here? I haven't done it. I haven't traded it, so I can't tell you. And if for those of you who have, put that in the comments. Please help the traders. Definitely put that in. But now let's look at this. Let's assume that you get some obnoxiously amazing price on put options. Let's say that for whatever reason, my historical volatility, or my implied volatility here, is 80%. It's like hugely different for the same strike as what my call option is. Now look at this here, right? So if I go here to my 35, where were we? 35,830, 35,830. Here's the price we got in at, here where my mouse is. Look at this gap. This line is no longer crossing here. It's no longer crossing this zero line. Look at this gap here, right? This little triangle here. That's the arbitrage. So what I'm saying, actually, let me really drum this home. If you look here, right, this now is still, money goes up, I make money. Money goes down, I lose money. So there's no pure arbitrage here because I can still lose. But I can take advantage of this mispricing here on the put option. Let's pretend that it was priced like this, right? There was a gap in the pricing. And I'm giving you an obnoxious gap here because I want to really show the size. I want to show it to you graphically. How do I hedge this? Well, what I could do is go and short Bitcoin. So I could go and sell the coin. Because I make money when things go down, I lose money when things go up, canceling out that curve. And so these three trades combined add up to profit no matter what. And then what will happen at expiration is I'll just close all the trades. So this is put call parity. What you can do is buy a call, sell a put, or buy a put, sell a call. And then hedge that with just trading the futures contract, or the spot price, whatever you're doing. And you end up with a net gain. And this is the beauty here of having all these different platforms. So what you could do is, and I would do this bot built basically, is there's a calculation you can do here, right? Work out, let's say using Deribit, for example, look at your bid and ask spread, calculate that in, factor that into your calculation because that's important, and look at it on both sides of the trades, right? So you want to make sure that you know all your trading costs, because to get in and out with bid and ask, etc., it's going to cost you money. So have a look at that spread first. And then have a look at what is it being priced at here, right, in this market. Is there an arbitrage? Can you arbitrage the difference and then just short or go long on whatever the underlying is? And I would look to do this over a short-term time frame, not 24th of June. And the reason I would look to do that is because I wouldn't want a situation where Bitcoin's priced, because it can drift a lot in 3 months, right? Or whatever, in 2 months. It can drift a lot. So I don't want to be in a situation where I'm going short on something, I'm being margin called, and now I have the issue of needing a lot of capital for this trade and blah, 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 right? So that's stuff that you might want to factor in. But I hope that gives you an idea of how I look at these. Now, you might be asking, what are these Wix options? This is just probability of touch. So for example, here, if I look at, again, 24th of June and the price of 36,000, the payout for it touching 36,000 is like 0, because it's saying, well, there's a 99.3% probability it'll do that. But now something interesting I wanted to look into here is if I select no, so if I'm betting the opposite, I'm only getting a 2.118x payout, meaning it's saying there's a 47.2% market probability that it will touch this. So I don't think this pricing here is very fair. And so what you could do is look at different ways of combining these options into a strategy where you have some kind of arbitrage. I'm not sure how to do it with probability of touch, but maybe you have some ideas. Anyhow, I really hope that this was useful for you, Diego, particularly, and also, Fauci, thanks for the recommendation to look at these other platforms. So take care and talk soon.